Hi, and welcome to Your Future, Your Finances. I'm your host, Brian Kuhn. We got a good segment for you today. We're talking about the investment markets. Do you follow the market? Looking for some ideas or perspective on that? We have a great guest for you today. Jon Giordani is Chief Investment Officer of Planning Solutions Group. Welcome to the show.
Thanks, Brian.
So take a moment to tell us a little bit about yourself.
Sure. It's my 20th year in the investment management industry. Like you said, I'm the Chief Investment Officer for Planning Solutions Group. We're a holistic-based planning firm located in Maryland that manages approximately $550 million for our clients. Prior to that, I worked in the institutional equities business for many years, helping large asset management firms, mutual funds, pension funds, etc., with good investment ideas.
And how did you get started in this industry?
Well, after college, I found myself very interested in reading books on legendary investors and their investment process. And I was very lucky to come across a fellow alum from Johns Hopkins University, a gentleman by the name of Gordon Croft. And Gordon was a pioneer that helped build T. Rowe Price to the global investment management firm it is today. He had left in the late 80s T. Rowe Price and founded a firm with his son Kent. Gordon was one of the legends of value investing, and he gave me a great opportunity, a tremendous experience that I'm forever indebted to.
And you're with Planning Solutions Group. What brought you to them?
Well, after I worked with the Crofts, I spent about 4 years working with investment banks, and I found that it really burned me out. It did teach me the inner workings of Wall Street, which was very beneficial, but the opportunity at Planning Solutions Group was like a breath of fresh air. They work primarily with individuals, and it enabled me to directly work with people and help them achieve their goals. Very impressed with the team approach that they follow, the culture of the firm, and I also saw a great opportunity to bring some institutional concepts to the average individual investor.
Yeah, you said worked on the institutional side. So it seems like there's some differences between how institutions invest and how individuals invest.
Yeah, I think that the couple things there. I think the biggest difference that I find is institutions really have a roadmap, a well thought out policy statement, and many individual investors do not. For an individual investor that has money in the markets, I'd encourage them to first identify their goals and develop a plan of how to get to achieve those goals. We have a plaque in our office with a phrase that says, a goal without a plan is a wish. And I just couldn't agree more. Before you invest, you should have a detailed financial plan. The investment strategy then is a natural fit, a side product to this plan. Many times when we work with new individuals or clients, we find that their investments have very little to do with their current needs or their future needs. They really haven't identified a hurdle rate of return, we like to refer to it. And what that means is the required return on that bucket of assets to help them achieve their lifetime financial security. The other big difference, and I think this is more alarming, is how much risk people have in their portfolios. Too often, the individual investor finds out when it's too late, and that's when the markets are down and they've suffered significant losses. Institutions, on the other hand, are very good at identifying and analyzing potential risks and dealing with them. And for the average investor, we just find that that's lacking.
So with individual investors, there's a behavior to overcome or to look out for, right?
Exactly. Markets in the short term are shaped by fear and greed. Valuations matter over the long run, but the average investor consistently does everything wrong. They love to buy high and sell low. Really let greed and fear influence their decisions. I mean, just think about the housing market in 2007, internet stocks in the late 90s. Investors just have the uncanny ability to want a market time. And really, when you look at it, the most money piled in to those assets right at peak prices. Studies show that the average investor can barely keep up with inflation. And I ask myself, how can that be when the average asset class we know does mid-single to upper single-digit returns? And really, it's not our faults. I mean, we're hardwired to act like that. You think about early man. I mean, his whole life depended on on avoiding risk. So it's natural that when you see your portfolio go down or you hear bad news, that you want to sell and get out. Also, behavioral studies. I mean, one looks at loss aversion, and then the conclusions there are that investors or individuals feel 2 times the intensity and feeling with loss than they do the pleasure of gain. And this really goes back to my earlier comments. I mean, having a financial plan in place, very important. It really will leave you much better prepared when the going gets rough. Also, having some safety assets in the portfolio, that's what I call the war chest. So when everybody's panicking and fleeing an asset class, if there's value there, that gives you something to take advantage of the opportunity. We know markets are volatile, so we try and eliminate fear and greed from the portfolio decision-making process.
So we're filming this in early September 2016. So the past 18 months have been volatile. This year, 2016, started out not too good,
right.
But now things have been better in terms of the market movements. Why do you think the markets have come back well?
I mean, you're exactly right. The first 6 weeks of the year was people just did nothing but sell risky assets, including stocks. And it was really due to a tremendous amount of negative headlines, everything from the European debt issues, a stronger U.S. dollar, the slowdown in China's economy, and an upcoming presidential election, and then thrown that most recently, the Brexit vote. At one point, the bad news took its toll. The average U.S. stock was down 34% from its 52-week high price. Now, since then, we have had a tremendous rebound, and why is that? It's really the bad news stopped. China's economy stabilized. Commodity prices, after falling, oil 70%, rebounded to where it is now above $40 a barrel. The Brexit, or UK voting to leave the European Union, yeah, that's an issue, but it's really for Britain. It's going to dent their economy. And we avoided a U.S. recession, which many people feel. But most importantly, I think, I always liken it to a coiled spring. Markets have been driven down. Fear and greed, greed indicators were at points, fear indicators were at points that we hadn't seen since 2008, that the natural course of a spring that coiled is to bounce back.
All right. Let's pick it up on the other side of a break. Good stuff. We'll talk more about the investment markets with Jon Giordani, CFA, and Chief Investment Officer of Planning Solutions Group. We'll be right back. You're watching Your Future, Your Finances.
Thanks.